these lectures is to supplement the written course, to present later refinements, and to aid you in learning and in integrating the principles into a full understanding of how the law of supply and demand relate to the stock market. In this series, there will be extensive discussions of individual principles. Wherever possible, we will cover only one main subject on each tape. However, in some lectures, there will be combinations of subjects. That simply cannot be helped. In reality, the principles all relate to one another in an orderly process. It is difficult and sometimes impossible to study a principle or market phenomenon in complete isolation. In this lecture, we will present some of the philosophy, history, and basic concepts of the Stock Market Institute and the Wyckoff course. Perhaps the most important concept for you to understand is our corporate purpose. SMI is a private business school teaching stock market science and technique and the art of speculation. We also function as a service bureau, offering essential data for technical stock and market analysis. We are a teaching institution and a service bureau, education and services. Education comes first and is our primary concern at this time. Let's look for a moment at how and where does the Wyckoff course fit into the stock market. There are generally two basic methods of stock analysis, the fundamental approach and the technical approach. The fundamental approach deals with balance sheets, profit and loss statements, estimates of management, new products, etc., and attempts to relate these to current and future value of an individual stock. Fundamentals can and are often used very satisfactorily for long-term moves, often lasting many years in duration. These fundamentals are one step removed from price, and the further you get away from dealing with the price of the stock itself, the more difficult your analysis problem becomes. The most serious defect of the fundamental approach is the absence of importance of timing. Timing is extremely important in the stock market. There is a good time to buy a bad stock, and there is a bad time to buy what has been a very good stock. And usually, by the time the changed condition of either the stock or the general market has shown itself in the fundamental news and statistics, the best time to make your purchase or sale has already passed. This is one of the reasons why people get locked into so-called good stocks for many years without realizing any profit. The technical approach deals with the price of the stock itself and regards the stock as a separate commodity, subject to the laws of supply and demand. There are two main branches in technical analysis, a mechanical approach and a judgment approach. Let's deal with the mechanical approach first. The commonly accepted grandfather of the mechanical approach was Schabacker, who wrote a very thick volume during the 1920s, and after comparing thousands of mechanical chart patterns described in such descriptive terms as head and shoulders, double top, triple top, gap, pennants, and so forth. He has been widely copied, and many students have been exposed to this approach before becoming a Wyckoff student. Our approach to the stock market is best described by the course title, A Study of Stock Market Science and Technique and the Art of Speculation. It is a complete, thorough approach in the understanding of how to make money in the stock market, how to accumulate it, and how to multiply its value. This came from the old-time professional stock speculators. There's a world of difference between theory and practical experience, and the Wyckoff course is based directly upon the practical experience of an outstanding professional stock market operator, Mr. Richard D. Wyckoff. A brief history of the Wyckoff course. Mr. Wyckoff was experienced and qualified in every important area of the stock market. Founder and publisher of the then prestigious Magazine of Wall Street, stock market advisor to thousands, author of numerous articles, editorials, and books based upon personal experience and his association with such famous speculators as Harriman, Keene, and Livermore, and with other leaders of finance during his era. Richard D. Wyckoff tells us in his own words, "By taking the best of what 40 years in Wall Street have taught me, and preparing it for others so that it can be readily absorbed and applied, I will be creating something that should aid in establishing a new standard of practice in the public's stock market operations. I do not claim any monopoly of stock market knowledge, but up to this time no one else seems willing to be so frank in offering to the public the most intimate knowledge of the inner workings of the stock market. Thus, with 40 years of study and personal experience, Mr. Wyckoff crystallized his knowledge into one writing and published the Richard D. Wyckoff course in Stock Market Science and Technique. Since then, the Stock Market Institute, formerly known as Wyckoff Associates Incorporated, has continuously endeavored to preserve the value of this course. As new principles have been discovered, they have been added to the time-tested laws upon which the curriculum is based. The same watchfulness applied to new techniques of market operation. These are being reviewed and developed as time, regulations, and market conditions change. Our knowledge and educational program is in a continuous state of evolvement and has been enhanced with each management succession. When death came to Mr. Wyckoff in 1934, Mr. Robert E. Stanlaws assumed the responsibility to continue to offer the public specialized education in the stock market science and technique. He expanded the program with material he and Mr. Wyckoff had written since the original printing. In 1951, Mr. Robert G. Evans began his career as the promulgator of the Wyckoff course. Mr. Evans has made considerable contributions to the benefit of all students of market action. They are most notable in the further development of technical analysis, market psychology, and philosophy. His unique talent in using analogies to explain various market phenomena and principles have become an inseparable part of the Wyckoff course. Lloyd I. Andrews was selected in 1967 to continue SMI's leadership in educating the public in a true understanding and knowledge of stock speculation. Mr. Andrews placed emphasis in the development of a structured educational program to enhance and speed up the learning process. He has expanded the SMI with both experienced educators and market speculators. Today, SMI proudly offers over 75 years of continuous study in stock speculation, a proven product, professionally prepared and presented by a uniquely competent staff of principled people. It is our experience that you will discover you have no need for anything more of any other technique than Wyckoff. And should you use other techniques along with your Wyckoff course, it can hurt you. This is a very difficult thing for many students to accept, because most students prior to their Wyckoff experience have tried to learn about the market by picking up an idea here, picking up an idea there, trying them out, and if they show reasonably good results, using them. Often these people become intellectual gimmicks collectors. Forget it. It'll cost you money, much money. You have enrolled into a proven, time-tested program. Please discipline yourself to learn it, practice it as taught. Don't return to a trial-and-error approach. Actually, there are many good things written in books, but often they are mixed up with other ideas and concepts which are not valid. It is a long, costly, and difficult process to determine what is valid and what is not. At SMI, we have already sifted out what is good and useful, and after thorough testing, have incorporated it in the Wyckoff course. It has already been done for you. Actually, many things which we read or hear about simply are not reliable. For instance, occasionally you will read, "The short interest is the highest in history," and this is interpreted as being very bearish. This high short interest may be perfectly natural because of the increased and increasing number of stocks which are outstanding and are traded. Again, you may read that the market went down today, but it was on less volume, and therefore that is perfectly normal. In fact, there are times when it is perfectly normal for the market to go down with somewhat decreasing volume, and that can still be bearish, depending upon the circumstances. You see, very often the basic assumption that is made is completely wrong, and that leads to disaster. Again, you may have read that a gap is always filled. Sometimes it is many years before a gap is filled. There is still a gap on Chrysler at 2 5/8, which was established in 1932. Do you want to wait for it to be filled? Many are never filled. When a gap is filled, it is accidental or incidental to the movement of the stock. If a principle is to be a principle, it must work in all markets to be valid and reliable. The Wyckoff course is based upon principle and laws. It is valid. It is reliable. SMI believe that There is a very definite distinction between short-term trading compared to trading important accumulation or distribution areas for intermediate and major moves. The short move trading often requires what is essentially a tape reading technique and a special understanding of the market. Trading the major accumulation or distribution areas for a larger move is more readily understood. For most students, it is more profitable, and it is the method of operation which should be learned first. It is the basic method discovered and practiced by Mr. Wyckoff. This is described very well in the text in sections 9, 10, 16, and 17, and is summarized in section 21 of the Wyckoff course. This type of operation lends itself readily to long-term capital gains, which under our present tax laws is a vital concern to many of our students. To trade a major accumulation or distribution area, you must have a large count, a sign of strength, and a last point of support. We would like to emphasize this essential strategy, that you must have a large count, a sign of strength, and a last point of support. Stay out of the stock until it is on the springboard. We will emphasize this repeatedly and illustrate it in later tapes. This is the precise area where accumulation is being completed, and an attempt is being initiated to begin the markup process. Now, just what do we teach, and what can you learn at SMI? We teach the science, the technique, and the art of speculating in the stock market. Let's review the definition of these three terms. Science. Definition. Knowledge of facts and laws arranged in an orderly system. This is precisely our endeavor. Our study of stock market science provides a careful insight into the sociological and psychological aspects of market operations. We study the characteristics and habits of the individuals and groups participating. We probe why the varying mental attitudes of these groups have an effect upon stock prices, and how the character of the market is influenced by psychological conditions. Further, we expect the student to discover the importance of his mental attitude and the effect it will have on his degree of success. Through continuous practice trading, he will learn that disciplined application of knowledge can overcome the common obstacles caused by one's hopes and fears and one's timidities and obstinacies. Technique. Definition. Method or way of performing the mechanical details of an art or science. Our approach to the stock market requires up-to-date records prepared from the factual data of daily price action and volume of sales as compiled by the principal stock exchanges. Vertical line and figure charts are constructed for 1. The individual stocks of particular interest, 2. Carefully selected indexes of leading groups, and 3. Sensitive indexes reflecting the condition of the general market. From these we are able to make a serious and instructive study of the action of the stock, together with the action of other stocks of a similar character, and finally, the action of the market as a whole. Our students are schooled in the techniques we believe are essential to technical analysis. Speculation. Definition. Buying or selling where there is a large risk with the expectation of making a profit from future price changes. We believe speculation is an art and a science whose fine points may be readily learned by those who will apply themselves to their studies. To become successful, one must operate in the style of the men who have proven their expertise. Learning the modus operandi of these astute gentlemen will assist the student in developing this professional attitude toward the stock market. Each student must learn to understand the meaning of these definitions, as well as the Wyckoff principles through systematic study. Then it's practice. Practice trading to test his understanding of their application and to determine how he can best operate with them. Then, when ready, he will begin to speculate with his capital. It is important that we have a common language. In Volume 2 of the course, we have included a glossary of terms. Whenever you are uncertain as to the exact meaning of a term, we suggest that you refer to the glossary. If you find a term that is not explained there, refer to your dictionary or ask us for our definition. Occasionally a term will be used in a special way with a special meaning of SMI. This arises out of our special usage and understanding of the market. It is often helpful for a student to relate the technical terminology, that is, the language of analogies being used, down to whatever he does in his daily life. This may help in using the principles and may prevent them from being purely abstract ideas. An illustration of what we mean can apply to the term selling climax. Knowledgeable speculators understand selling climax to be the phenomenon which occurs after a stock has been going down, down, down and has reached the point where panic selling begins to set in, leading to a dumping of stocks by people who bought at higher prices. This panic selling creates an expansion of the price spread and an expansion of volume. The price weakens at an increasing rate. The price characteristic is that it sharply increases. At the point where the professionals, come in and absorb this panic selling, the down move is over and the stock begins to rally. We call this action a selling climax. The Wyckoff principle of a selling climax does not always occur at the end of every decline. In other words, not all declines end with a selling climax, but when it does, when you can identify it clearly, it is a principle. We can have a common understanding that this is the principle of the selling climax and act and operate accordingly. The principles do not change. However, they may manifest themselves in many ways and where the price and volume will be different on each occasion. It is very important to realize that the Wyckoff course is based upon sound principles. The principle has been defined as a comprehensive and fundamental law, doctrine, or assumption. It is an unchanging rule. Prove your principles. Learn how the principles tie in with each other, and learn to anticipate which principle is likely to occur following the current unfolding picture of market activity. Build your analysis on principles, not upon your feeling about the stock, not on your hopes, dreams, and wishes. That which is built upon principle is sound and will last. Please turn